Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby, and today we're joined by Kelli Marti from Nuveen, Churchill, to learn why she believes investors can profit from private market investments as public market volatility soars. Thanks so much for joining us today, Kelli. It's awesome to have you here in Australia, all the way from the US.
That's right. Happy to be here.
As I mentioned in the intro, we have seen a lot of volatility in public markets recently. Has that bled through into private markets?
You know, it really hasn't. And there's a distinct difference between valuations that are ascribed in the private markets versus those in the public markets. In the public markets, you see a lot of supply-demand imbalance, and that can cause volatility in the underlying prices of the loans, despite the creditworthiness of the underlying borrower. That volatility, that supply-demand imbalance, is eliminated in the private markets. So the valuations ascribed to the loans that we're underwriting are really a true reflection of the underlying credit performance of the borrower, so much less volatility.
Let's go back to basics. You invest in middle market companies. What are those?
Sure. So in the US, we often interchange the words private credit with middle market. And the middle market is a very wide range. It really encompasses three distinct segments. We have the lower middle market, and we would define that broadly as companies generating below 20 million of US dollars of EBITDA. The traditional or core middle market, where we at Churchill invest, would be defined as companies generating broadly between 20 and 80 million of EBITDA in the US. And then the upper middle market would be defined as companies generating above 80 million of EBITDA. And the underlying company and credit characteristics of those three segments can differ.
It sounds a lot bigger than what we would have here in Australia anyway. What is the risk return profile of those companies?
Sure. So right now, we're investing in the senior secured top of the capital structure. These are floating rate instruments. They're based on SOFR as the base rate. And we're earning between 10.5% and 11% for these assets. So a really nice risk return profile for investing at the top of the capital structure, the most secured debt in the structure. That's about a 200 basis point premium over what you would earn in investing in the public debt markets. So from a risk perspective, these companies are smaller, but that's not equating to a higher risk. It's all about choosing the right investments, picking the right borrowers, and more importantly, structuring the transactions appropriately with low leverage and a significant sponsor contribution in the capital structure.
Many market commentators are predicting that we'll see quite a lot of interest rate cuts over the next 12 months. How does that play into returns?
It will certainly reduce returns a bit, but on the flip side, it's easier for borrowers, right? So this high interest rate environment has been nice from a yield generating perspective, but it is creating a more expensive debt profile for our borrowers. We've certainly structured our businesses to withstand the debt burden that we've put on them, but a lower interest rate environment would be welcome from an interest coverage and fixed charge coverage perspective.
Okay, last question for today. We've had quite a few famous market commentators in Australia talk about this oncoming zombie apocalypse in private credit and debt. Are you seeing that play out in middle market companies?
It's a great question, and there's certainly been some headline grabbers out there with kind of a fear tactic being employed in the papers and in the press. And in the US, we're really not seeing evidence of that. I think a big driver of that fear is the fact that there's this perception that there's been a flood of new entrants into the private credit market. And is that creating too much demand on these assets, and are we doing things that are unnatural to our business? And I have to say that from our perspective, to be a new entrant in the private credit space would be a very difficult position to be in. You have to be an established manager to really get the transaction opportunities. We've been doing it in the market for 18 years. We have a consistent deal flow, so we don't have to stretch to unnatural levels to find the assets that we want to invest in. So again, the headlines I think are misplayed. If we look at our portfolio specifically, we have 300 US middle market borrowers that are in our portfolio. We have very tight management of that portfolio. We're not seeing systematic cracks in our portfolio. If anything, we're seeing very strong performance in our underlying borrowers, and it's really a testament to the way we approach these transactions, our conservative nature, and our very high selectivity for transactions. So no, I think a zombie apocalypse is definitely not on the horizon.
Okay, well, thank you so much for your time today, Kelli. It was awesome to feature you on The Pitch.
Thank you. Thank you for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.